What's going on, everybody? Mic is working. Perfect, perfect. All right. So today I want to go through this trade recap where we took this trade for NQ for about, what is this? Almost a 30-point gain with over a 4 risk to reward. The trade literally went perfectly for us, never a second really against us. So I kind of want to break it down for you guys, and hopefully, you guys can learn from this. So personally, my edge is all about trend lines, as most of you guys know. Trend lines continuation. So basically, what can we see here coming down from this trade? Coming from the higher time frame. So notice how this morning, what can we see? Strong displacement candle to the downside. What is that telling us already? Actually, let me backtrack even more. What is market structure doing first and foremost? So let's go to the hourly. What do we see going on with market structure here? So right now we can see a lower high. We see, or we're starting, actually, let's just start right here. Let's just start right here. So coming here, what do we see? Did we ever break this market structure here? No, we do not. So what does this make right here? A lower high, right? Bingo. Lower high, right? In relation to this high. So what do we see next? Here is where we would get the break of market structure, right? Why is that? Because this is where we make that most recent higher low in relation to this low, right? So because this is the most recent higher low right here, right? Because this is the most recent higher low, once this level gives out, this is where we see that break of market structure at this point right here. So once we manage to break this level, which we do here on the hourly, we now get a confirmation that trend is now shifting to the downside. Why do we know that? Well, we never made a higher high yet. We continuously are making lower highs, lower lows, and we just managed to break the most recent lower high that we have with a clean body close through, right? So therefore, that's already signaling us to target the downside. Our job is to figure out what is the drawn liquidity to the downside. So if we know the higher time frames are all pointing down, right? Our job is to not to necessarily catch along. We don't want to catch along. Why don't we want to catch along? Well, let me just show you. Let's go down to the lower time frames, right? Let's go to the 15-minute. So after we got this break of structure here, notice what do we do here? We come up, grab liquidity, right? Nothing more than liquidity grab up here. Come up, bearish engulfing right back down on a 15-minute, right back down we go, right? Do we ever clear out this high? No, we do not. So this high right here is nothing more than liquidity grab. We already see that we have the breakup structure. We have the clear body close to the downside. So now our job is to say, where is the downside going to go? But if you were going to be one of those traders that are so complacent on just fighting the trend, well, guess what? This is what you got every time you tried to go long. So let's just say you got a long entry. You took a long entry. Guess what? You got PT1 up here. Did you get any more? No, you did not. So chances are, if you were one of those traders that are looking to, get a 100-point move, a 300-point move, well, guess what? To the long side, not very likely. But to the short side, playing with the trend. Notice how the shorts play out. Let's just say, hey, look at this long here again, right? Let's just say you come down here, you try the long, you don't even really take out a buy side liquidity. On the higher time frames, at least. This would have been likely like your hourly buy side or your 4-hour buy side. Do you take that out on this retracement here? No, you don't, right? Now, look what happens when you take the shorts. What did we do this morning? Came up, swept this liquidity, back down we go, right? So something I often tell traders, the best setups to take are after the masses have been stopped out. What do we see right here with this liquidity grab from 10:15 this morning, right? The massive stop loss were all sitting right here at this 214 level. They all got taken out. Notice how the market reacted after that liquidity was taken. So going based off of that, we know our trend is to the downside. Our focus needs to be to the downside for the day. And then as well, what does that look like on an hourly candle? Do you see what we did? Literally just liquidity grab. So this is where all of these back context is very, very important for this trade setup. Because now we know every time we see this retracement to the upside, we know not to take it. Guess why? Because chances are you're probably not going to come take out any buy side liquidity. You're probably going to get stuffed at every single IFVG or FVG you see. And that's exactly what happened. So we got our initial entry was to go short here. Everybody knows 12 o'clock, I'm not trading, I'm at the gym. So came back after the gym. I said, okay, cool. Hey, we might have a potential entry. We already know what the drawn liquidity is. We know the drawn liquidity at this time was 71. We know that. How do we know that? Well, we come back here in a 5-minute. This was a 5-minute drawn liquidity. So for this trend continuation model, it's very, very important to know the trend. If you don't know the trend, this model is not going to work out for you. If you don't know the drawn liquidity, this model is not going to work for you. I would highly suggest to watch either T-Trades or just ICT himself to learn more about the drawn liquidity. I will teach you more about those liquidity levels in a future video, but mainly for this video, it's mainly more so to learn about this trend continuation model. So coming here, one thing we need to see with this setup is a breakup structure. We need to see a breakup structure. With that displacement, we need to see some aggressiveness. Why do we need to see the aggressiveness? Because that's going to tell us, hey, for the very given moment that we're in this trade, very likely we're going to get continuation after we go back and sweep minimal or internal buy side liquidity because the trend is down. So that's exactly what we do here. We get the breakup structure. That's the first thing that's going to catch our eye. Now, what else do we see? 3-minute. This is something so important. So important. So important. We have to have an equilibrium block. If there's no equilibrium block, this trade is not going to work out. So let me remove this. Let's go look here. What do we see here on the 3-minute? We see that equilibrium block. A more perfect time frame to look at this would be something like the 6-minute. So let's just go look at the 6-minute. Oops. 6-minute, not 6 months. Bingo. So what do we see? Two things are lining up here for this A+ trend continuation model. When I say it works out 99% of the time, 99% of the time. If you take this model 100 trade setups, 99% of the time it will work out. That 1% of the time it stops you out, it's just likely because your stop loss was too tight. So, and as well, this trend continuation model works on all time frames. I just like it on the lower time frames. I'm a day trader at heart. So we see that 3-minute or 6-minute equilibrium block. We see the 1-minute breakup structure. We also have this 1-minute volume imbalance, or not volume imbalance, my apologies. Fair value gap. Very, very huge. Why is this huge? Because we know fair value gaps are meant for retracement. If a fair value gap fails to get a body close above it, what does that likely mean? We're getting that continuation back to the downside. Why do we know that? Because fair value gaps are meant for retracement and retracement only. Now, before you ask, hey, what liquidity was taken? Well, let's go down. This is where you have to be versatile as a trader, right? Come look at the 2-minute. You're going to see something. Look here at the 2 minute. Notice how we have all of these confluences telling us short me, short me, short me, right? The 2 minute, what do we have here? We have a 2 minute volume imbalance right here. And then we also have another volume imbalance right here. So I just ultimately just made it a bigger box, expanded the range. So now that we know this is the volume imbalance up here, we know how the market has to go seek that imbalance. So therefore, after the market rebalances itself, what do we do here? This is where we get that spike, that pretty much move, that aggression that we needed to get that continuation back to the downside. Now, as you can see, let's go open up this really quick. Execution labels. All right. So looking at the execution labels, what time do I enter this? Where do I enter this trade? I enter this at the bottom of this FVG. After I see this candle close and I see the rejection of that volume imbalance there, instantly, green light, go. I'm a type of trader where I don't necessarily like to predict the market. I like to react. So the reason why I didn't have an entry up here was because guess what? We don't have any 100% confluence or confirmation that it's going to go up here until we see the rejection back down below this fair value gap, which we end up seeing. So this is where I start taking 4 shorts. As you see, I get a short fill at 108 and then a short fill at 109.50. What do we see here? I see that we get the confirmation. I see that, hey, we just got a body close back below this level, right? So what do I always tell traders? When you know you're right, add to winners. If you have any psychology problems with your trading, if you ever are struggling as a trader and you're saying, man, I keep taking trades and then I keep cutting it when it starts going my way, guess what? Something that will fix that is just by adding to winners. So what do we see here? I add to my winners, add to my winning position as we don't get a body close over that fair value gap. Stop loss is where? Stop loss is the most recent wick. What do we know? We know the drawn liquidity is where? 71. Look at that. A 5.3 risk to reward, right? Look at that. So you can see my execution level. Look at that. You see where we got out? At 74. So we took a 4.8 risk to reward based off of this trend continuation model. When I say it works 99% of the time, 99% of the time. If you have any questions, please feel free to just comment down below. I'll get back to them. Or you just shoot me a message on Twitter. As you see, my Twitter is floating below, Zeus Trades. I'm here to help in any way possible. And as well, going forward, next month, we are actually picking up on our last monthly mentorship program. So if you are interested in a mentorship program, please feel free to shoot me a DM and I will send you full details for that. We will kick off November 1st. Thank you for watching this video, and if you enjoyed it, please drop a like and subscribe, and I'll see you in the next one.